Imagine you're getting into a car, and the steering wheel works perfectly. The engine, purrs with all this incredible power.
Right.
But there's this terrifying design flaw.
Right.
The pedals, your gas and your brake, they're wired directly into your neurochemistry. So when your heart rate is resting, everything is totally normal. You accelerate smoothly, you brake at the lights, but the second you get nervous, the moment your amygdala spikes with adrenaline,
The pedals swap.
exactly, the brake and the gas secretly swap places.
And, in that state of physiological panic, you'd inevitably just stomp on what you think is the brake, only to find yourself accelerating wildly out of control. It's terrifying because your actual instinct for self-preservation becomes the exact thing that guarantees a crash.
And the harder you try to fix it, the worse the wreckage becomes. So if you're listening to this, welcome to today's deep dive. You, the learner, are in the passenger seat with us today as we pull apart excerpts from Gregory Scola's audiobook, The Leaking Pound.
A fantastic source, by the way.
Oh, totally brilliant. Our mission today is to uncover the mystery of why our money quietly disappears, even when we are, trying our absolute hardest to grow it. Because, as Scola points out, we are all driving that rigged car. Human psychology is literally hardwired to make us terrible investors.
Yeah, we truly are up against our own evolution here. Today, we're going to break down how our survival instincts basically betray us in modern financial markets, and, more importantly, how flipping those deeply ingrained natural instincts upside down is the key to building wealth.
Okay, let's unpack this. Because Scola argues that the average investor's mind is, well, it's nowhere near a rational machine. It's an emotional roller coaster fueled by this exhausting tug-of-war between two massive forces, fear and greed.
Right, the classic duo.
Exactly. And instead of just listing out the 9 phases of this emotional cycle, I kind of want us to look at how this plays out for real. Think about a massive trend, like some revolutionary new AI tech company hitting the news.
Yeah, that's where the cycle always begins. Phase 1. Optimism. You hear about this new company, the economy seems stable, and you start paying attention. Your prefrontal cortex, the logical planning part of your brain is still driving the car.
Still in charge, yeah.
Exactly. So you decide to allocate a small amount of capital, which transitions seamlessly into phase 2, excitement. The stock price ticks upward. And this is where the neurochemistry shifts. Your brain registers that financial gain and rewards you with a hit of dopamine.
And dopamine is incredibly addictive. So you cross right over into phase 3, euphoria. You're checking your portfolio app on your phone. You see those green arrows, and this really dangerous thought forms like, oh, I have figured this out. I am inherently a genius at this.
The ego takes over.
Totally. The greed convinces you that the upward trajectory is permanent. You throw significantly more money in, completely following the herd. But mathematically, because the hype is at its absolute peak, you are almost always buying right at the top of the market.
And markets never move in a straight line forever.
Yeah.
They just don't. The inevitable dip happens. Suddenly we hit phase 4, anxiety. You watch the numbers turn red. But rather than analyzing the actual company, you find yourself paralyzed. You do nothing, just watching the value erode.
Which is really just a psychological defense mechanism leading straight into phase 5, denial.
Oh, yeah. It's a temporary correction.
Exactly. You rationalize it. You tell yourself it'll bounce back by next week. You're just holding on, trying to protect your ego from admitting a mistake.
But the bleeding doesn't stop. It drops further, and denial shatters into phase 6, fear. The dopamine is gone, completely replaced by cortisol. You're actively watching your wealth evaporate, and you think, I could lose everything. You start seriously considering selling just to stop the pain.
And then the financial news networks are flashing those bright red banners warning of an economic collapse. And that fear accelerates into phase 7, panic.
Which is the worst place to be.
Right. Your amygdala has hijacked your brain. You are desperate for safety. So you sell everything just to get out. But because this panic is universal, everyone is selling at the same time. The price hits its absolute lowest point. You sell at the bottom.
Leaving you in phase 8, despair. You've locked in the loss, you feel foolish, and you swear you'll never touch the market again. You stay in cash. Until, years later, the market slowly creeps back up, you enter phase 9, recovery, you start feeling that optimism again, and the entire devastating loop resets.
Wow. Yeah, it just starts all over.
What's fascinating here is that this cycle forces investors into a systematic pattern of buying high and selling low. It's the literal opposite of wealth generation. Greed suppresses our perception of risk when prices are soaring, whispering that we're missing out. Then, fear amplifies our perception of risk when prices are at their cheapest, screaming at us to abandon ship.
It makes me think of being trapped in a brutal, miles-long traffic jam. Like you're sitting in the left lane and it is completely gridlocked, just parked.
Ugh, the worst feeling.
Right. But you look in your rearview mirror and the right lane is inching forward. You watch 5, then 10 cars roll past you. And driven by that fear of missing out, that sudden surge of greed, you yank the steering wheel and swerve into the right lane.
And the immediate result of that action, the moment your tires cross the dotted line, the right lane stops dead.
Every single time.
Yeah.
And the left lane, the one you just abandoned out of impatience, suddenly clears up and starts flowing. You allowed panic to make you switch lanes at the worst possible moment, right as your original lane hit its recovery phase.
If you had just sat there, enduring the frustration of being stopped, you would have progressed.
Exactly. But by reacting to every stop and start, you guarantee that you remain perpetually stuck.
That beautifully illustrates the trap. And Scola makes a critical point for you, the listener, to internalize here. Successful investors are not robots. They don't have some genetic mutation that makes them immune to fear and greed.
They feel it too.
They feel the exact same cortisol spike during a crash, the exact same dopamine pull during a rally. The defining difference is that they simply learn to act despite those emotions rather than acting on them.
Here's where it gets really interesting, because understanding the psychology is one thing, but Scola attaches a hard mathematical price tag to this behavior. We aren't just talking about abstract stress.
No, not at all.
We need to look at what this emotional roller coaster actually costs in real currency.
Yeah, the math on this is sobering, and it entirely explains the title of the audiobook, The Leaking Pound. Let's look at his breakdown of 2 hypothetical investors to see the mechanism of this leak in action. We'll call them Investor A and Investor B. Both begin with the exact same starting capital, a £10,000 investment in the exact same market.
Okay, so 10 grand baseline. Investor A is our disciplined driver. They put the money in, ignore the sensationalist news, refuse to switch lanes, and over time, let's say they capture the market's historical average of an 8% annual return.
Now look at Investor B. They are invested in the same underlying assets, but they're riding that 9-phase emotional roller coaster. Buying into the euphoria peaks, panic selling during the despair troughs. Because of the friction of these trades, Investor B only earns a 4% annualized return.
And it might sound like 4% versus 8% isn't a massive gap, but that ignores how compound interest works. It isn't linear, it's exponential.
Exactly. Let's trace the timeline.
Yeah, after 10 years, Investor A's original £10,000 has grown to over $21,000. Investor B, who's constantly fiddling, sits at just over $14,000. That's already a £6,000 penalty for letting their amygdala drive.
But the true cost reveals itself the further out we go. At the 20-year mark, Investor A has crossed £46,000. Investor B is lagging behind at around $21,000. The wealth gap has now stretched to nearly £25,000.
Wow. And the final picture after 30 years is just jaw-dropping. Investor A, who did absolutely nothing but stay seated in the car, holds a portfolio worth over £100,000.
And Investor B?
Investor B, who checked their phone every single day, bought the hype, and panicked during the dips, holds just £32,000.
That is a staggering £68,000 difference from the exact same initial investment. This brings us to the core thesis of the leaking pound. The market didn't punish Investor B. Investor B punished themselves through a slow, invisible psychological leak.
Right. Bad behaviors chasing trends, overtrading. They turn temporary dips into permanent losses. A £68,000 mistake just for needing to feel like you're in control.
It is life-changingly different.
It really is. It hammers home that your returns are dictated by your behavior within the market, not just the market itself. So, knowing that a lack of emotional regulation costs you 68 grand, it raises the question, how do we stop the leak?
The answer Scola provides is going to sound deeply counterintuitive. In fact, it sounds incredibly boring. He calls it boredom as a superpower, the do-nothing strategy.
Okay, wait, I need to jump in and push back on this behalf of the listener.
Okay.
Because this goes against everything we're taught. In almost every other area of life, taking action equals success.
Sure, yeah.
If my car breaks down, I don't do nothing. If a project fails at work, I pivot. In the physical world, action is progress. Why on earth is investing the total opposite?
That paradox is exactly what trips up highly intelligent people. If we connect this to the bigger picture, you have to understand that humans evolved as active problem solvers. If there's a threat, we fight or we run. We take action.
Right.
But the global financial market is not a tangible object you can wrestle into submission. It's a complex system driven by the collective psychology of millions. In investing, doing nothing is not laziness. It is a highly active, incredibly demanding form of discipline.
Active discipline. Okay, that frames it completely differently. It's endurance.
Precisely. The do-nothing strategy means regular monthly contributions and then long periods of total inaction, ignoring the noise, making minimal changes. The market doesn't punish patience, it punishes panic.
And the real-world evidence proves this time and time again. Think back to the dot-com bubble, like 1999 to 2000. Euphoria was off the charts.
A classic Phase 3 peak. And when it burst, the devastation was absolute.
But look at Amazon, a fundamentally strong company. During that crash, Amazon's stock price plummeted by over 90%.
90%, just imagine that.
Right. Imagine watching 10,000 pounds shrink to less than 1,000. The biological urge to hit Phase 7 panic and sell would be overwhelming. But the investors who practiced active discipline, who endured the agonizing pain of doing absolutely nothing, were rewarded with astronomical growth. The question isn't, will it fall? The question is, will it recover?
We saw the exact same trap during the 2008 financial crisis. Millions panic sold and locked in their losses because doing nothing felt irresponsible.
But those who stayed invested caught the massive rebound.
Exactly. Look at Warren Buffett. He bought Coca-Cola in 1988. He didn't trade it on the margins, he ignored short-term news, and he just held this exceptional asset for decades. No thrills, just relentless, highly profitable boredom.
Which brings us to the hardest part. Understanding doing nothing is easy right now while we're calm. But actually doing nothing during a market crash is agonizing. How do we force ourselves to be disciplined when our brains are screaming at us to panic?
You can't rely on willpower. By the time you feel panic, your prefrontal cortex is already compromised. You must build systems and establish non-negotiable rules while you are still calm.
There's a quote from Scola here. You don't rise to your goals, you fall to your systems.
It's so true. Automation is the first step. Remove the emotion from contributions by automating them. But he also details 4 interactive exercises to help you build your systems today.
Let's walk the listener through these directly because this is super actionable. Exercise 1 is about your emotional history. Think back to a past emotional financial decision.
We all have one.
Oh, definitely. Analyze it and adopt this personal rule. I will not make investment decisions based purely on emotion. Force a cooling off period.
Exercise 2 is the crash rule. Create a simple, non-negotiable action plan for when the market tanks. Literally write down, if my portfolio drops by 20 to 30%, I will.
So absolutely nothing for 30 days
Yeah.
or whatever it is. Just give your panicked future self a manual.
Right. Exercise 3 addresses the opposite, the FOMO rule. Set a hard limit on hype. Write down, I will never invest more than X% of my portfolio based on hype alone.
Define the limit before the euphoria hits. And the final exercise, exercise 4, is the ultimate challenge, the media fast. Scola says to spend one entire week entirely cut off from financial news to see how your stress levels change.
This raises an important question, though. Do you actually have the willpower to unplug from the financial news cycle for just 7 days?
It's harder than it sounds.
It really is, because that media is engineered to trigger your amygdala. Tuning it out is a massive strategic advantage.
So what does this all mean? Escaping that 9-phase emotional cycle and saving yourself a 68,000-pound mistake comes down to one simple, difficult truth: letting boredom be your superpower.
Let the systems do the work.
Exactly. But before we sign off, there's a final provocative thought we want you to ponder. The source material shows that humans crave action, stimulation, and immediate results, which destroys our wealth.
Yep.
If the urge to constantly do something and react to noise is so financially destructive in the stock market, where else in your life is this same impatience quietly sabotaging your long-term success?
Oh, that's a great point. Your career, your relationships, your daily habits. Are you tinkering too much?
Are you abandoning things the moment they stop feeling exciting? True compounding requires long periods of unbroken consistency. So trust the quiet power of consistency and take your foot off the gas. Thank you, learner, for joining us on this deep dive. Keep questioning your instincts, keep building those systems, and keep learning.